Today we're talking about why you should not be an S corporation in 2024. And by the way, we've done a whole series on S corporations, so if you're really looking to dive into this topic, check out our guide on this. You can find that at taxsavingspodcast.com/S corp. But before we dive into why you shouldn't be an S corporation, I want to talk about what is an S corporation, because a lot of people on here might be saying, okay, I shouldn't be one, but what is an S corporation? And so an S corporation is simply a tax election. So in order to be an S corporation, you need to be set up as an LLC or a corporation, and then you're electing for that entity at the state level to be taxed as an S corporation. So that's all an S corporation is. It's not a structure that you set up at the state level. It's a tax election on an already established structure. So like I said, you're either an LLC or a corporation, and then you elect for that entity to be taxed as an S corporation. And a sole proprietorship is not considered an entity, and therefore a sole proprietorship cannot be an S corporation, cannot elect to be taxed as an S corporation. The only way to be taxed as an S corporation is to have an LLC or a corporation set up at the state level. And the main reason that people utilize or set up an S corporation is to avoid self-employment taxes. So basically, let's talk about a quick example. If you're set up as a sole proprietorship or single member LLC, 100% of your income is hit with self-employment taxes. And self-employment taxes is 15.3%. It's Social Security and Medicare. And the total is 15.3%. Now, once you hit about in the 160, 170 range, something like that, the Social Security hits a max. And so then it's just Medicare after that. So it's 15% up to about that 160, 170 mark. And then anything over and above that mark is 3%, is essentially what self-employment tax is. And so if you're set up as a sole proprietorship or a single member LLC, 100% of your income, of the profit of your business gets hit with self-employment taxes. And so a lot of the reason people set up an S corporation or elect for their entity to be taxed as an S corporation is to help avoid some of that self-employment taxes. And how does that happen? Well, with an S corporation, basically the profit from the business does not get hit with self-employment taxes. But with an S corporation, you're required to take a reasonable salary, W-2 payroll to yourself as the owner for the work that you're doing inside that business. So with an S corporation, we essentially take your income, your profit of your business, and split it into two pieces. A portion of it's going to go towards a reasonable salary for you as the owner for the work that you're doing. And the other part's going to take as a distribution or an owner's draw or a dividend. And when we do that split, basically you still pay self-employment taxes essentially. Now it's not called that, but essentially it's the same rate and everything else. You're paying self-employment taxes on that reasonable salary that you take, but you're avoiding it on that amount that you take as a distribution or owner's draw. So again, with a sole proprietorship or a single member LLC, you pay self-employment taxes on 100% of your income. With an S corporation, we split your income into two pieces, a reasonable salary, and we pay self-employment taxes on that reasonable salary piece. But then the rest, anything over and above that reasonable salary that's part of your profit of your business, we take as an owner's draw or a distribution or a dividend, and we do not pay self-employment taxes on that distribution, dividend, owner draw piece. So let's go through a quick example. We had a business owner that I was talking to a couple days ago that's in part of TaxHelm. And they were making about $150,000 a year, currently operating as an LLC, but a single member LLC, no S corp election or anything like that. And so we talked about this idea of, does S corp make sense? Or at least let's run the numbers and see what it was. And so their profit in their business and in their single member LLC was about $150,000. And so they were paying self-employment taxes on that full $150,000 of 15.3%. And so we said, okay, let's imagine that we do decide that maybe an S corp election might make sense for you. What are we going to take as a reasonable salary for the work you're doing? And so we did some calculations and part of the worksheets and everything else that we have within TaxHelm. And we determined that a reasonable salary for this specific person was $60,000. So they had $150,000 in profit, but we determined a reasonable salary for the work that they were doing was $60,000. So now if they were to elect S corp status, instead of paying self-employment taxes on $150,000, we're paying it only on $60,000. In that remaining $90,000 that we didn't take as a salary in this example, they would just take as an owner's draw or distribution, and they're not paying self-employment tax on that owner's draw or distribution. So in this example, for this client making $150,000 a year, we determined a reasonable salary was $60,000. If they were to go the S corp route, they'd be looking at tax savings about $11,500 or more every single year in tax savings simply by electing for the LLC to be taxed as an S corporation. So I wanted to preface this to say, okay, what is an S corporation? That's essentially how an S corporation works. We're electing for our current entity, either an LLC or a corporation, to be taxed as an S corporation. As part of that, we are now required to take W-2, pay ourselves W-2 payroll as an employee of our business. And that amount that we take as W-2 payroll gets hit with self-employment taxes, but we avoid self-employment taxes on any income over and above that amount. Now, with an S corporation, we also will now have to file a separate business tax return. So when we were just organized as a single member LLC, we would file our business activity on a Schedule C on our personal tax return. Now that we're taxed as an S corporation, we're going to have a completely separate business tax return. That business tax return's going to spit out a K1. And that K1 is where we're going to report the profit from that business activity onto our personal tax return. So a few more steps to go through, more work, some additional costs because now we have a business tax return and our personal return. So there's going to be some additional tax prep fees. We also are now required to run a reasonable salary. So there's going to be some additional payroll fees involved in that as well. So now let's talk about the main topic. You might be saying, well, that's great, Mike. $11,500 in tax savings. Who wouldn't want to go that route? So the first main reason why we would not do an S corporation is if we have passive activity. And so passive activity is something that we're not actively involved in. So let's think about a rental property. If I have a long-term rental, I'm just collecting rents every month. I'm not actively participating. It's not a business for me. It's just a passive activity for me. Well, passive activities, we don't pay self-employment taxes on. And remember, the main reason for being an S corporation is to help lower the amount that we pay in self-employment taxes. So if we're not paying self-employment taxes, there's no reason to be an S corporation or elect S corp status. And it can actually hurt us in other ways by electing S corp status. So if we have a passive activity, a rental property, we would never want to elect for that entity to be taxed as an S corporation because we're not paying self-employment taxes anyway. So that is one reason why you shouldn't create an S corporation in 2024. Another example would be, let's say that you are just an investor, a passive investor in a business. A friend started an electricity business, or they were going on their own to be an electrician. They said, hey, I need some funds to start this entity. And you said, hey, I got some extra funds hanging around. I'll help fund this for you. I'm going to be a partner. I'm going to be a partner in this business, but I'm just going to be passive. All I'm going to do is fund it. You're going to operate the business, and I'm not going to do anything of that. Well, in that instance, we wouldn't want that to be elected as an S corporation status specifically for you because it's a passive activity for you. You're not paying self-employment taxes. And we'll talk about some entity structuring as well. So if you have a passive business, no need for an S corp status. And actually, we don't want it because it could actually hurt us in other areas when it comes to taxes. Another reason you shouldn't be an S corporation in 2024 is because your business is too small. If your business is profiting $10,000 per year, just self-employment taxes on that is fairly minimal. So you're paying $1,500 in self-employment taxes on $10,000 of profit. But if we elect S corp status, you'd have to run payroll. That comes with a cost. We'd have to file a separate business tax return. That comes with a cost. And you'd still only avoid self-employment taxes on maybe half of it. So let's say that you were making $10,000 a year. You took a reasonable salary of $5,000. So now by doing an S corp, we just eliminated your tax bill by $750. But now we have to run payroll. That costs X amount of dollars per month. Now we have to file a separate business tax return. That's going to be an extra $1,500, $2,000 in cost. So at the end of the day, by doing that S corporation, we're paying more in payroll costs and we're paying more in business tax prep fees than we saved in taxes. That's a disadvantage. So if your business is just too small or not making enough, an S corporation is not going to make sense. Or maybe expect your business to decrease or close soon. We wouldn't want to make that jump into an S corporation, go through that work and that hassle if it doesn't pencil out in paper and make sense. So typically, when do we say an S corporation generally makes sense is once you have profit of around $50,000 or more. So if your profit's under $50,000, we're going to say S corporation doesn't make sense. Now start an LLC and operate as an LLC so that once you jump over that mark and once your business grows to the point where an S corporation does make sense, we can easily do that S corp election at that point. But let's not rush into it. Don't just think, oh, because they're talking about S corps here and they're talking about S corps here, I need to be an S corporation. That's not always the case. This episode is brought to you by TaxSome. At TaxSome, we understand that saving taxes can be complex and overwhelming for business owners. That's why we're here, to be that tax strategist in your back pocket, ensuring that you pay the least amount in taxes as legally possible. With TaxZone, you receive a tax savings blueprint tailored to your business needs, unlimited access to our team of tax experts, and an annual one-on-one live consultation. You'll also have access to our comprehensive training with videos, downloads, templates, workbooks, guides, and so much more, along with our monthly live trainings to keep you informed and in control. Thousands of business owners across the country trust TaxZone. It's time you did too. Visit us now and take that first step towards paying the least amount in taxes as legally possible. There has never been a better time to join TaxZone. Do not forget about our 30-day money-back guarantee. We guarantee that we will present tax-saving strategies that will, at a minimum, cover the cost of your subscription fee or your money back. This is your risk-free invitation to explore the benefits of TaxZone membership and how it can transform your approach to tax planning and savings. Go to taxelm.com. That is TAXELM.com. Now back to the show. Another reason why you might not want to be an S corporation is if you have foreign owners. Part of the S corp election requirement is that you cannot have foreign owners if you want to elect S corp status. So you're going to immediately get stopped there. You can't be an S corporation if you have foreign owners. And we're going to talk about, again, a workaround and how we might structure that, where you personally, even if you have foreign partners, you could work out a way where you personally could have your income taxed as an S corporation, again, if it makes sense. Other areas we say why you shouldn't be an S corporation is if you live in a state or maybe a city where the laws are unfavorable to S corporations. And some that come to mind where we at least need to run the numbers or think about it a little bit deeper is Tennessee and New York City. In those states and city, we need to run down and drill the numbers a little bit deeper. So sometimes it's not going to make sense. Even though you're going to see federal tax savings, you might see increased local or state tax savings that outweigh your federal savings. And why would we do that? Another reason that we might not look at an S corporation, where an S corporation might not make sense to you, is if you have another high-paying W-2 job where you're already hitting that Social Security max. And so a lot of times in this case, we say, if you have a high-paying W-2 job, say you're paying $200,000, $300,000 in another W-2 job, we might not want to do an S corporation until your business starts to hit about 200 or more in profit, and then we might look at an S corporation. Again, we need to run the numbers a little bit deeper. If you have lots of investors or you're a big company, you're planning to go public, you're not going to be allowed to be an S corporation. With an S corporation, you can only have one share of stock, and you can also only have 100 shareholders. So if you're planning to go public, let's look at Uber or Apple or Amazon as an example. They wouldn't be an S corporation because they have investors all over the place. They're very large businesses, and they wouldn't go down that route. Now, a lot of people say, they start a business and be like, I'm going to be the next Uber, or I'm going to be the next Amazon. And I love that concept. I love that idea. But if you're just getting started out, let's plan for where you're at right now. So you might say, well, an S corporation makes sense. Even if I plan to be the next Uber, an S corporation might make sense for me now. And then as my business matures and as I get closer to that point, then I can reevaluate, reorganize. But talk to an attorney, talk to a tax accountant if you're in that type of situation. So when should you not create an S corporation? You have a passive business. Don't need that in an S corporation. Your business is too small. The costs of an S corporation, the payroll costs, the extra business tax return costs are going to outweigh any savings you have. Not going to want to do an S corporation. You have foreign owners. Not going to want to do an S corporation because you can't. You have unfavorable state or local laws where it doesn't make sense. Maybe you run the numbers a little bit deeper. Or maybe you have another high-paying W-2 job and your business isn't just making enough to get the full benefit of that self-employment tax savings in that situation. So that's some of the reasons on why you shouldn't be an S corporation. Now, there's a lot of people out there that should, and there's a lot of people out there that shouldn't. And so it's understanding where are you at in that spectrum. And again, like I mentioned, we have a full guide with a bunch of different lessons and training and everything you need to know about S corporations that is free to all of our listeners. And so go to taxsavingspodcast.com/S corp if you want more information on that. Now let's talk about ownership opportunities where you can have a partnership, but then still you own an S corporation. We did a training on our podcast. We did an episode on this where how do you structure your business if you have multiple businesses that you own, or how do you structure your business if you have partners in your business? And we talked about having kind of this main S corporation that's sort of this parent company that you own 100% of, but it has your ownership in these other entities. And so that is a good opportunity, a good way to structure this. And we talk a lot about this in TaxHelm and structuring your business, but definitely check out that podcast episode that we did on that, our YouTube video on that as well, where we talk about If you have, let's say you have foreign partners, you can have a partnership, but your ownership in that partnership is your S corporation. So you're still getting the S corp benefits, but it's not affecting anybody else that's part of that. And that's one of our favorite setups. If you have multiple owners, we would have your ownership. You would create a partnership for that entity, and LLC tax as a partnership for that entity, but your ownership in that entity would be through your S corporation. So you can do whatever you want in the S corp status route. Again, we still want to make sense. Is your profit and is your income enough and all those different things we talked about, but that is a good structure to do. Now, the key thing when we talk about S corporation, we talk about any tax strategy, is we need to dot our I's and cross our T's. We need to make sure we're doing this correctly, because a lot of people, they hear me talk about S corporation and say, hey, that sounds great, Mike. And you know what? I'm going to actually do something tricky. I make $150,000 per year, and I'm going to take a salary of $1,000 because now I avoid self-employment taxes on $149,000. I would say, well, that's in concept, in theory, a great idea because that's maximizing your self-employment tax savings. But the IRS doesn't like that. The IRS is going to come knocking immediately because they say $1,000 is not a reasonable salary for the work you're doing. And they're going to come knocking and asking you to defend that, find it, that's not a reasonable salary. And now you're paying back taxes, penalties, fees, and everything else. So with any tax strategy we always talk about is that the concept, we need to know the concept, understand it, see if it makes sense in our business. But then we need to dot our I's and cross our T's and make sure that we do the implementation correctly. And that implementation, correct implementation, is the key. With an S corporation, we need to make sure that we're electing status correctly. We need to make sure that we've dotted our I's and crossed our T's on what is a reasonable salary and are we taking a reasonable salary? And are we using an accountable plan? Are we taking self-employed health insurance correctly? All these different things that we help everybody out with on a regular, everyday basis in tax home that's looking to make this jump into an S corporation. So let's kind of summarize where we've been today and why you shouldn't create an S corporation in 2024. First off, what is an S corporation? And an S corporation is simply a tax election. So you need to be an LLC or a corporation. You have to have that set up. And once you have those set up, then you can elect to be taxed as an S corporation if you wish. And the main reason to set up an S corporation or to elect S corp status is to help minimize the amount that we pay in self-employment taxes. Remember, as a sole proprietorship or a single member LLC, we pay self-employment taxes of 15.3% on 100% of our income. So if our business profits $150,000, we're paying self-employment taxes on $150,000. With an S corporation, if we had that same LLC that we then elect for that LLC to be taxed as an S corporation, we split our income into two pieces: a reasonable salary for the work that we're doing and distribution draws, dividends on the other piece. So of that income that we have, that $150,000, we take a reasonable salary. That reasonable salary we're paying self-employment taxes on. But anything over and above that reasonable salary, we avoid self-employment taxes on. So I gave an example of a member that came through Tax Helm that was looking into an S corporation. They were making $150,000 a year. Within Tax Helm, we had them go through our worksheets and guides and everything else and determine that a reasonable salary for the work that they were doing was about $60,000. And so in their instances, making $150,000 a year, we determined that a reasonable salary was $60,000. We're going to pay self-employment taxes on $60,000, but we're avoiding self-employment taxes on the remaining $90,000. And that resulted in tax savings of over $11,500 for them. That was in year one when they elected S Corp status, in year 2, 3, every year after that. Very, very powerful opportunity. But now let's talk about why you shouldn't be an S corporation here in 2024. If you have a passive business, you're not paying self-employment taxes. If you have rental properties that you are not actively participating in, or you just have rental properties, you're not paying self-employment taxes on the income from that rental property, and there is no reason for you to elect S Corp status on that. So if you have passive businesses, avoid S corporations. If your business is too small, let's say you're profiting $10,000 a year, we're not going to want to look at an S corporation because the added cost of an S corporation, remember with an S corporation, we take a reasonable salary. There's cost involved with that. With an S corporation, now we need to file a completely separate business tax return. There's costs associated with that. And so if your profit's too low, the amount that you save in self-employment taxes will be wiped out by the additional costs from being an S corporation. So typically they say once your business starts to profit around $50,000 or more per year, that's generally when we start to go down that route of does an S corporation make sense? If you have foreign owners, you can't be an S corporation. S corporation cannot have foreign owners. So if you have foreign owners, we might look at an opportunity where you set up a partnership. Your ownership in that partnership is your S corporation. Again, if it makes sense, is the income high enough? is it a business that you're actively participating in? If you're in a state or locality that has unfavorable tax laws, the two major ones that come to mind are Tennessee and in New York City, we want to run the numbers. Does it make sense? Will the savings that we get from the federal side on self-employment tax savings and the additional cost for an S Corp outweigh the additional taxes we might have to pay at the state level or local level? If you have another high-paying W-2 job, you might be already maximizing out Social Security. And so you might say, well, where does that number make sense? And so typically we say once you have profit from your business of over $200,000 in addition to your W-2 job, that's when we might want to start looking at it again. And if you have lots of investors planning to go public, S Corporation probably is not the route for you. So those are kind of the main reasons on why you shouldn't be an S Corporation. But if you don't fall into those shouldn't category, then we might want to be looking, does S Corp make sense to me? Again, the biggest thing when we talk about S Corporation and any tax strategy is we need to make sure that we're implementing it correctly. We're dotting our I's, crossing our T's, doing every step exactly the wrong way to prevent ourselves and protect ourselves in the event of an audit. So hopefully that was helpful. My goal here again was to give you an understanding of S Corporation. What is an S Corporation? When does it make sense? What are the benefits of an S Corporation? But more importantly, today we talked about what are some reasons why you should not be an S Corporation, because so many people are pushing S Corps. And you hear it everywhere. I need to be an S Corporation. But I don't know how many people come into tax out that really shouldn't be an S Corporation. They did it too early or it didn't make sense in their specific situation. And I hope this was that door to say, I need to revisit this. I need to join TaxElm and talk to an expert. I need to talk to my accountant. I need to figure out, does an S Corp make sense for me or not? And then make that decision of what that next step forward is. Again, we have a full guide and everything you need to know about S Corporations that's free to our listeners. You can go to taxsavingspodcast.com/S Corp and get access all that information that we have in there. I hope this was helpful. And I hope that this was helpful for you to say, yeah, now is the time for an S Corporation, because guess what? S Corporations make sense for a lot of business owners out there, especially those making $50,000 or more in profit. But there are instances where it doesn't make sense. And we never want to rush into something just because everyone else is talking about it. So take what we've talked about here today, look at your situation and determine, does S Corporation make sense to me or not? And then make the moves from that. So I want to thank you for listening to another episode, and I will see you next week when we continue this deep dive into how can we make 2024 that you pay the least amount in taxes as legally possible.
This has been another episode of the Small Business Tax Savings Podcast. If you enjoy our weekly episodes, please leave a review and share with other business owners. You can find previous episodes and more information at www.taxsavingspodcast.com. Thanks for listening and have a great day.